So let me just start from the right basic. What is an option? So basically, option is a contract between two parties. Okay, number one, option is a contract between two parties. So of course, in terms of exchange wise, you can just think of it this way. The exchange just facilitate the buying and selling of contract, but also still within these two parties. So you think about this. So like for example, in stock exchange, we buy and sell stocks is just two parties. So same, instead of buy and sell stocks, the exchange allow us to buy and sell options. That's all, buy and sell options. Now, what does this contract do? Give you the right at a certain price, at a certain time to buy or sell the underlying instruments. Okay, so this contract, it gives you the right at a certain price, at a certain time to buy or sell the underlying instruments. No? So in fact, most of us actually has dealt with options before. If let's say if you have bought or sold a property before, you would have actually used the options. Okay, I'm quite sure if you have bought or sold a property before, you must have heard of this term called OTP, options to purchase. Yes, that is exactly the same options that we are talking about. So of course, the OTP is actually just what we call over the counter. Okay, you actually meet the person. Okay, the stocks options is the one that's actually traded in the stock exchange, but the purpose is the same. So think about this. When we actually buy property, we actually sign this thing called OTP, options to purchase. So maybe I use Xiong Yo. Xiong Yo is a seller of the property. So if you think about it, if let's say I want to buy Xiong Yo property, so when we have decided to buy, okay, the first thing I have to sign is actually this thing called the OTP, option to purchase. Now, basic option to purchase is a contract, okay, written by Xiong Yo to me. Xiong Yo actually write this contract to me, option to purchase, and I have to pay him a fee for an option fee. So a lot of times, let's say I think HDB now is minimum like $1,000. I give Xiong Yo $1,000, and Xiong Yo have to give me this contract. Now with this contract, okay, the OTP, this contract, I have the right to buy the property. Okay, I have the right to buy the property. Okay, I can choose to buy. Okay, now the question here is this. If let's say I choose not to buy, can or not? Don't mind, can you help me answer into the chat? So if let's say I'm the buyer of the property, now number one, I actually pay an option fee. Xiong Yo actually give me this OTP. So this OTP give me the right to buy. But if I actually choose, after a while, I decided I don't want Xiong Yo property more, I don't want to buy, can I actually don't buy the property? Yes or no? Don't mind, can you help me type the chat, please? Okay, anybody else? Just only one reply. Okay, thank you so much. Can we don't buy. But if let's say I choose not to buy, okay, can I get back my option fee? Can I actually get back the option money that I actually pay to Xiong Yo? Yes or no? Okay, no. Thank you so much. Okay. So that contract actually gives me the choice. But from Xiong Yo's side, here's his obligation. If I choose to buy, he has to sell. He has no choice. Why? Because he collected my option fee. He actually sold me this contract. Of course, if I actually don't buy, yeah, then too bad, and then there's no deal, but he keep the option fee. Okay, but if I choose to buy, he definitely had to sell. Okay, so this is option for the property, and like I said, that this is exactly how the option works in the stock market as well. So the only difference here is this: for property, you actually see the person, you see the buyer and seller. There is really a paper, the exchange. But of course, in stock market, so all this is actually done on an electric platform, the stocks, whereby you actually buy and sell. If you really want to visualize in the stock market, we're actually buying and selling all these contracts. Okay. Now, let's talk about stock options. Look at stock options. So again, okay, number one, basically options is a derivative instrument. Options is a derivative instrument. So what it means is this: when it's a derivative, by itself, there's no value. Its value is actually derived from an underlying asset. So in this case, option is just a contract. It has no value. Its value is derived from underlying asset. So let me use this example to illustrate. So let's talk about stock investing. Assuming you go and buy Apple share today, you go and buy $120. So if let's say Apple share price rise to 150, ROI is 25%. So 150 minus 120 divide 120. So you actually make a 25% gain. So that is how what happened if let's say just buy plain enough shares, don't use option. Now, so in the US market, or in the options market, now this is what you can do. Instead of me buying Apple share, I can actually go and buy this thing called the options. Okay, I can actually go and buy this thing called the option. So very likely the options has a cheaper price. So again, it's same option to purchase. So imagine so when I buy, Xiongyo is the one that write the option to me. So this is what happened. I actually give Xiongyo $10. I actually give Xiongyo $10 to buy a call option. And with that option, Xiongyo actually give me a contract, the option saying that I have the right to buy Apple shares from him at $120. So this is what happened in options market, in US market, you can actually buy this piece of paper, buy this piece of contract through the stock market. So don't always think that stock market only sells stocks. No, stock market can sell a lot of things. Like for example, in Singapore stock markets, you can actually buy warrants, you can actually buy funds. They don't just only buy stocks. So in this case, in US, they actually have a very defined options market whereby I can actually buy this contract. So once again, come back to this example, I actually buy option $10. So Xiongyo will collect my $10 and Xiongyo have to give me a contract saying that I can buy an Apple share from him at $120. Now, if let's say, for example, Apple share price increased to 150. So this is what happened. Of course, I will exercise this contract. Okay. So if let's say price got 100, I will actually take this contract, run to Xiongyo, you agreed to sell to me at 120. So after that, I actually pay 120 to Xiongyo. And I can actually get the Apple share. And Xiongyo has to deliver because he actually write the options to me. He has his obligation. He had no choice. He have to deliver the Apple share to me, and I just have to pay 120. And what I do next is I can immediately just sell the Apple share to the stock market because the price is 150. I can sell it to the stock market 150. So in that sense, I make a profit of $30. And think about this. I made a profit of $30, but how much did I actually invest? I only put $10. So I put $10. Profit $30, my ROI is actually 200%. 30 minus 10 divided by 10, my ROI is actually 200%. So that's what options can do for us. If let's say you just go for plain vanilla stock, you're going to buy Apple share 120, price go up to 150, you only make 25%. But let's say you actually buy options, and same thing, the price increase from 120 to 150, the ROI is actually 200%. 200%. Anybody has any questions so far? So like I said, this is a class. Feel free to ask questions. Anybody has any questions so far? Let me just stop here for a while. Again, like I said, I'm actually monitoring the chat, and those on Facebook, I'm actually monitoring the comments. If there's any question, please let me know. Anybody has any questions? Or do me a favor, if let's say whatever I say is clear, please help me type a 1 onto the chat, please. Thank you so much. If let's say, no need to pay high when we exercise option. So of course, the detail, I'm actually doing in a very theoretical form. Actually doing it in a very theoretical form. You can of course sell the options. Okay, so that part I will actually want to let Xiongyo explain. I am just want to let you understand what's option work. Yes, the actual transactions may not be you pay the 120. Yes, you are correct. Okay, so far, if let's say you understand what I'm talking about, please help me type a 1 on the chat, please. So again, Alvin, I leave that question to Xiongyo. So again, like I said, I just want to go through a theory part first. Xiongyo later will go through all these questions. Okay, thank you. I just want to, we have some of our friends here who really know the options. I just want to answer their concern first. Okay, good. Thank you so much.
One more advantage of options. They don't have to pay the $120 upfront. That means less capital outlay.
Okay. Thank you.
You want to elaborate on that, or you want me to elaborate on that?
Probably I'll leave it to you later lah.
Okay, can.
Later, I think during your live demo, you will probably talk about this, right?
Yeah.
Okay, I'll leave it. I'll leave it for you later. Huh? Okay.
Okay.
Thank you so much. Thanks.
Yeah.
Thanks. Okay. Now, so if you are ever into options, please, you must understand this thing called the payoff diagram. So that day I was actually quite disturbed. You know, there's actually this person, she said she actually went through some option course, and she don't even know what's a naked call, naked put, and don't even know how to read payoff diagram. I think that's very dangerous. So like I said, please, if there's only one thing to take away from today's webinar, let this be the message. Okay, options is a higher risk instrument. I say that again, options are higher risk instrument. Why? Because you can lose more than what you invest. So please understand that. So that's why, you know, a lot of all these basics, you have to grasp it before you can really do the trading. Yeah. Okay, now there are actually 4 basic risk profile, as you can see here, or what we call the very 4 basic option strategy. So these are the most basic. We call it buying a call. Okay, we use write and sell interchangeably. When you write a call means you are selling a call. Okay, then you can buy a put. Then of course you can sell a put. Like I said, write is equal to sell. So once again, write and sell can be used interchangeably. Now let us go into detail. Now we talk about the most basic options, buy a call options, which is what we have been talking about just now. This is the example here. So let's say currently the stock price is $55. Call premium is the price of the contract. So of course, all these are pseudo numbers. All these are assumed numbers. We just want to illustrate. The actual numbers are definitely not going to be the same. And the strike price is basically a delivery price. So when I buy a call option, so again, so this is just me and Xiong Yu. When I buy a call option, what happened is buy a call give me the right to buy the underlying instrument. Okay, once again, buy a call give me the right to buy an underlying instrument. Okay, so okay, I actually buy at what price? I actually buy at $5. Current stock price is 55, and the strike price is 50. Okay, now this is what happened here. If let's say, for example, after I buy the option $5, the price dropped to, let's say, $30. Okay, so again, this is just between me and Xiong Yu. Would I actually want to go to Xiong Yu and say, hey, Xiong Yu, I got this contract. I want I want to buy the stock from you at $50. Would I do that? Okay, I repeat my question. So assuming this is what happened, I buy the option at $5. Current stock price is 55. Okay, the strike price is 50. That means I can buy the stock at $50 from Xiong Yu. Okay, now assuming that now the price dropped to $30, would I want to exercise my contract, or would I actually want to go to Xiong Yu and go and buy the stock from me at $50? Yes or no? Okay, thank you so much. No, of course not. Why? Because, you know, I can buy at $30. Why I actually want to buy at 50? So of course this option will expire worthless. Okay, I just lose that $5. So this is what the chart says. So if let's say this is you buy a call, okay, you would have lost $5 if the price will drop below 50. Okay, but if let's say the price increase, let's say the price increase, so assuming the price go up to become $70, okay, would I exercise my call option? Okay, do I actually go to Xiong Yu and say, hey, Xiong Yu, this contract, I can buy from you at $50. Would I actually want to do that if let's say the price of stock go up to $70? So yes or no, do I actually exercise? Yes, thank you so much. Yes, why? Because I buy at 50, I sell in 70, I actually make $20. So this is the payoff diagram of a buy call. When you buy a call, this is the payoff diagram. You would actually lose 50. Sorry, if you actually lose $5, if let's say the price actually go below if actually go below the strike price, as you can see here, okay, you actually gain when the stock price go up, you actually gain. So in this case, if you actually buy a call options, what's going to happen? Your profit is unlimited, but your loss is limited. Can you see? Your loss is limited. Maximum you lose is actually $5. The most is you just let the option expire. Okay. Now this is how Xiongyos look like. So of course, if I buy a call, Xiongyo will be selling a call to me. So basically his payoff will be opposite. So when you sell a call, the seller is sell call binds you to the obligation to sell the underlying instrument. So that means this is not a right. When you buy, you have the right. That means I can choose to exercise, I can choose not to exercise. But you sell, you don't have right, you have the obligation. If your buyer exercise, you are obliged to deliver. Okay, so see a difference. So you can see Xiongyo 1 is the exact mirror image. Whatever I lose is actually his gain. So when the stock price drop, okay, that means I don't exercise, that means Xiongyo will gain. Why? Because it expire, Xiongyo actually make $5. But if the price increase, like for example, if the price increase, okay, if the price increase, that means I will exercise. That means Xiongyo will have to go and buy from market at higher price and sell to me at lower price, and hence making the loss. Okay, or simply put, think of it this way: if I buy call, whatever I make is actually the loss of the call seller, and vice versa. Whatever I lose is actually the profit of the call seller. That's how it works. And so down here, you have to take note that if you sell call, can you see that your loss can be unlimited? If you sell call, your loss can be unlimited. Okay, there's a question for Yu Ying. Do you have to own the stock to sell a call? No. The answer is no. You don't have to own the underlying stock at all. But of course, if you talk in terms of risk management, yes, you may want to do certain things. I'll talk a bit about it later. Okay, but you are actually allowed to just buy and sell call without owning the underlying stocks. Okay, now the other one is this thing called a put. Okay, call and put. So buying puts give you the right to sell the underlying instrument. So just now call give you the right to buy the underlying instrument. So buying puts give you the right to sell the underlying instrument. So the difference is this. So again, let me have walk you through the payoff diagram. So let's say, for example, I buy a put. Okay. So if let's say, for example, when the price go up, I have the right to sell to Xiongyo at $50. I have the right to sell to Xiongyo at $50, assuming now the price is actually from the market. The price of the market now is $70. I only have the right to sell to Xiongyo at $50. Will I exercise this option? Yes or no? Okay, once again, this is my question. So now I actually have this. I actually buy strike price 50. Okay, I actually buy a put, and the price actually go up to $70. Okay, and I have the right to sell to Xiongyo at $50. Would I actually exercise? Okay, thank you so much. The answer is no. Why would I exercise? Because I can sell to the market at 70. Why I actually want to sell to Xiongyo at 50? So I know. So in that sense, if the price go up, I will just let the option expire worthless, and I lose that $5. Okay. So vice versa, if let's say, for example, the price drop, as you can see here, at the price drop, no matter what the price drop to, okay, I can sell to Xiongyo at 50. So of course, if let's say price drop to 30, then Xiongyo have to buy from me at $50. So I can go and buy from market, sell to him. Okay, and Xiongyo actually, I will actually make money from Xiongyo. So in that sense, if I buy puts, if the price drop, my profit can be unlimited. So again, sell puts is just a mirror image. You can see sell put is just a mirror image. Whatever same thing, whatever I gain is the seller loss. Whatever I loss is the seller gain. So this is just a mirror image of sell puts. So again, please take note, sell puts, your loss can be unlimited. So of course, if you think that, okay, this stock, the price will go up, you sell put, okay. Why? Because after that, you just earn a profit here from the premium. Okay. Then of course, if you think that the price is going to drop, then that's what you're not going to do. Okay, there's a question from Sean. Am I right to say that if my portfolio is a bullish position, I'll need to take a buy put position to offset the risk?
Okay, maybe this one we address later because this one
Okay.
talks about more sophisticated option strats that are
Okay.
used by, let's say, the more advanced investors as well as institutions. This is what we call protective puts.
Thank
Yeah.
you so much. Thanks. Thank you so much, Seong-Yo. Thanks.
Yep.
Okay. I'm going to pass to Seong-Yo very soon. Again, like I said, I'm here to just to cover the theory part. There are some who have not heard options. I just want to cover the theory part. I'll actually leave all the practical part to Seong-Yo. He is the man. He is the one that have sleepless nights trading in the US markets using options. Okay, and of course later you can quiz him with all the difficult questions. Okay, maybe the last theory part I want to go through is this. So how you can actually generate regular income from options. So this is a very common strategy. Okay, this is a very common strategy applied by a lot of people. So what happened here is this, like, for example, a lot of people know that I'm a long-term investor. I actually buy stocks and hold for long-term. Okay. So no matter what, when actually price drop, price increase, I don't care. So as long as I like the company, I think the company is still good, I will continue hold. So that's what I do. So with options, you can actually generate a little bit more of income if you're already doing that. So how does it work here? So let's say, for example, I own this stock. Okay, whatever stock it is, Apple, Tesla, whatever. And I have the intention to hold it forever or hold it for a very long time, 3 to 5 years. And basically, I'm investing in a company, which is what I do, which is what I really do as a long-term investor. Okay. Now, if I actually do that, okay, of course, this is the payoff diagram. When the price drop, okay, I lose money. When the price increase, I make money. So that's how the blue line represent. Okay. So if I just buy and hold, I can only make money from dividends. Obviously, I can only generate income from dividends. So, but with options, I may be able to generate a little bit more income. Okay. So let me just walk through with you this numerical example. So let's say, for example, the current stock price is $50. The call option, the call premium is $5. Price of the call option is $5, and the strike price is $55. Okay. So this is what I'll do if I want to earn the additional $50. So assuming now I haven't bought the stock yet, I buy the stock at $50 with the intention to hold for long term. I buy 50. Then after that, I sell a call with a strike price of $55. Okay, I buy the stock $50 and I sell the call strike price of $55. Okay, that means what? I actually make an additional $5 here. Okay, I actually make additional $5 here. So if the price drop to $40, okay, if the price drop to $40, okay, so if you can remember, if I sell call, the options will not be exercised. I will actually keep that $5. And of course, if the price drop to $40, I actually make a paper loss of $10. Okay, but now don't forget, like I said, when I buy 50, I have intention to hold for long term. So to me, that paper loss, hey, okay, if of course you have a long-term investor, then it may not matter as much. So indeed, you actually make that $5, then I just wait out. So this is for those long-term investors. If you actually want to just, instead of just getting a regular income from dividends, this is something you can do. And if of course, if let's say, for example, you do the same thing, you buy at $50, you sell call with a strike price of 55. Okay, if price increase to 60, option will be exercised. Okay, you still keep the options profit of $5. In this case, the option buyer will actually exercise. So you have to sell the stock. You have sorry. You have to sell the stock to him at $55. Okay, you bought at 50. Then you have to sell 55. You make additional $5 lah. Okay, from the option buyer. So net you actually make $10. So in that sense, if you do this, and of course, if let's say the stock market go up, yeah, your profit is capped lah, but you actually still make the profit. But if let's say the stock market go down, okay, you just keep collecting the options fee lah. So it's just like collecting dividends. But of course, this is talking about you actually like the stocks you actually want to hold for long term. Okay. So this is the last part. Yeah. So that's basically what I mentioned. Of course, later Xiongyo will give you more examples. So this is what have I done just now? I just covered the theory part of options. Like I said, I'll leave all the practical aspects to Xiongyo. So basically, these are some of the benefits. A low capital. Okay, like I said, let's say Apple shares, you can, if you want, can buy 120. But instead of 120, you can just pay 10. You can actually profit in both bull and bear markets. So like there are different strategies. You can buy call, sell call, buy put, sell puts. You can still make money even if you're wrong. This one I will let Xiongyo do the explanation, and of course can be a hedging tool. So these are some of the benefit options. Of course, the risk is this. The risk is this, especially if you talk about selling calls or selling puts. You can have unlimited loss. Okay, unlimited loss. Okay, unlimited loss. So that's where the risk can come to place. Why is it higher risk? Because like in this case, let's say you sell puts, you only make $5, but your loss can be unlimited. Also, of course, if you really want to do this, you must understand the risk management system very well.